Picture this. It's a quiet Tuesday morning. You're still in your pajamas, sitting at your kitchen table with a cup of warm coffee, watching sunlight slide through the blinds. The phone buzzes. Just another notification, right? But when you glance at the screen, you freeze, because it says 1,000 deposited. Not from your job, not from a side hustle, simply from owning shares of companies that decided to share their profits with you. It almost feels like magic. Money showing up while you're doing nothing at all. But this isn't magic. It's dividends. And what's even more fascinating? This isn't some impossible dream reserved for Wall Street millionaires. It's absolutely achievable, and the math behind it is simpler than you might think. I'm Mike from Mike Compound, and on this channel, I break down money, investing, and wealth building into simple stories that anyone can understand. If the idea of earning passive income, money that flows in even when you're not working, sounds like your kind of dream, then make sure to hit that subscribe button. Because today, I'm going to show you exactly how much you need to invest to earn $1,000 a month in dividends. But before you start imagining yourself swimming in cash like Scrooge McDuck, let's take a step back. Building up in bonds a month in dividend income isn't some get-rich-quick trick, and it definitely won't happen overnight. Yet here's the surprising truth. It's also not as hard or unreachable as most people think. The real question isn't whether you can do it. It's how much you actually need to invest to make it happen. That's where most people get confused, and it's where we're going to make things crystal clear today. The answer depends entirely on something called dividend yield, the percentage of your investment that gets paid back to you each year in the form of dividends. Think of it like an interest rate, but instead of a boring bank account, you're getting paid by real companies that make real products, sell real services, and share real profits. For example, if you invest $10,000 into a stock that has a 3% dividend yield, you'll earn $300 per year just for owning it. No calls, no shifts, no alarms, no meetings, just ownership. But here's where most beginners fall into a trap. Not all dividend yields are created equal. Chasing the highest yield you can find, the one flashing 12%, 15%, or even 20%, can be like chasing fool's gold. It looks shiny at first, but it often hides danger underneath. Imagine you're walking into a store and you see a giant 80% off sign. That sounds amazing, until you realize everything on sale is broken, outdated, or falling apart. In the same way, an unusually high dividend yield can often mean the company behind it is struggling. Maybe its stock price has crashed, making the yield look inflated. Or maybe the company is paying out more than it can afford, which means those amazing dividends could vanish the moment things go wrong. That's why experienced investors usually look for yields between 2% and 5%. It might sound conservative, even boring, compared to those flashy double-digit numbers, but wealth isn't built on excitement. It's built on stability, patience, and consistency. Let's put it in perspective. Imagine your dividends as a tree. You could plant a small, healthy tree that grows slowly and gives fruit every season for decades. Or you could grab a magic tree that promises instant fruit but dies after one harvest. Which one do you want in your backyard? The goal isn't to get rich fast, it's to get financially free, slowly, steadily, and securely. Because when your money works for you, life starts to change in ways that go far beyond the numbers in your account. And that brings us to the big question, the one you probably came here for. How much do you actually need to invest to earn $1,000 every month in dividends? The answer will surprise you because it changes dramatically depending on what kind of investor you are, what kind of stocks or funds you pick, and how long you're willing to play the game. In the next part, we'll break down the math behind it. And once you see how it works, you'll realize that financial freedom might be a lot closer than you ever imagined. Let's get into the real numbers, the part most people get completely wrong. If you want to earn $1,000 per month in dividends, that's $12,000 per year of passive income. Sounds simple enough, right? But how much you need to invest to make that happen depends entirely on the dividend yield, the rate of return companies pay you just for owning their shares. Let's say you choose a dividend-focused investment fund that yields around 3% per year. This is what I like to call the classic route. It's not flashy, but it's stable. These are typically made up of established companies. Think utility providers, big consumer brands, and major retailers, the reliable ones that keep paying dividends year after year, even when the market gets bumpy. At a 3% annual yield, you'd need about 400,000 invested to earn 12 us a year, or your goal of £400 a month. Now I can already hear the collective gasp. $400,000? Mike, are you kidding me? That's more than the price of my house. And I get it. That number sounds huge. But here's the thing. Dividend investing isn't about having that money right now. It's about building toward it, one contribution at a time, letting your money grow and compound over years. But before we talk about building, let's understand the other side of the equation, the yield. Because the yield is what decides how fast you get there. Let's compare 3 possible paths: conservative, balanced, and aggressive. 1. The conservative path versus yield. Like we said, this is the stable, long-term approach. Companies that have been paying dividends for decades, sometimes increasing them every single year. It's not thrilling, but it's dependable, like driving a Toyota that never breaks down. You're not going to double your money overnight, but you'll sleep well knowing your portfolio isn't a ticking time bomb. 2. The aggressive growth path, broad yield. Now let's say you prefer companies that reinvest most of their profits instead of paying big dividends. Companies focused on growth. These pay smaller dividends, maybe just 0.5%, but they grow much faster in value. At a 0.5% yield, you'd need a massive $2.4 to $2.5 million to earn $12,000 a year in dividends alone. That sounds crazy, but here's the twist. Because these companies grow faster, your investment value increases more quickly, and you can occasionally sell a small portion of your holdings to supplement your income. So while the dividend checks might be smaller, your wealth might grow faster. 3. The balanced path, around 1 by yield. This is the middle ground, and it's where many smart investors live. You invest in something that tracks the overall stock market, giving you a mix of both dividend income and capital growth. At around 1.5% yield, you'd need roughly 800,000 invested to reach that 1,000 per month mark. Still a big number, sure. But remember, it's less than half of the conservative approach and far safer than chasing ultra-high yields that might disappear overnight. Now here's where things get really interesting, because most people stop right here. They think, okay, I'll just chase the highest yield I can find. But that's where portfolios go to die. Let me explain. When you see a dividend yield that's unusually high, say 10%, 12%, or even higher, you need to ask why. High yields can sometimes be a warning sign that something's wrong. Maybe the company's stock price has crashed, making the yield look bigger on paper. Or maybe it's paying out more than it earns, which means those juicy dividends could vanish next quarter. It's like a restaurant giving out giant discounts because no one's showing up anymore. You might enjoy a cheap meal today, but will that restaurant even exist next year? That's why professional investors always look at more than just the number. They look at payout ratios, debt levels, and dividend histories. Because dividend investing isn't about chasing the biggest return, it's about chasing the most sustainable one. And here's something most people overlook. Dividends don't just pay you. They often raise your pay over time. Many companies increase their dividend payments year after year, giving you what's essentially a built-in raise for doing absolutely nothing. Imagine if your boss automatically bumped your salary every 12 months, no questions asked. That's what a good dividend portfolio can do. So by now, you understand the basics. The higher the yield, the less you need to invest. But the higher the risk. The lower the yield, the more stable your income, but the bigger your starting capital. So what happens if you want to reach that 1,000 per month target faster without risking everything? There are a few specialized strategies that can help, but they come with trade-offs. And in the next part, we'll dive into those. From energy companies to REITs and dividend aristocrats, you'll see exactly how different types of investments can shape your income and your future. All right, now that you understand how dividend yield works, let's take the theory and make it real. Because numbers don't lie, but they do tell very different stories depending on how you play the game. Let's start with the conservative path, the 3% yield strategy. This is where most investors begin, and for good reason. A 3% yield is what you'd typically find in a broad dividend fund or among the so-called dividend aristocrats, companies that have paid and increased dividends for decades. These are your blue-chip giants, the utilities that keep your lights on, the consumer staples you use every day, the massive retailers that seem to survive every crisis. They don't make headlines for explosive growth, but they deliver something far more valuable: consistency. And consistency is the true foundation of financial freedom. At a 3% yield, you'll need around $400,000 invested to earn your $12,000 per year, or $1,000 a month. But here's what makes that number a lot less intimidating than it sounds. Those dividends often grow. Many companies have been increasing their dividends for 20, 30, even 50 consecutive years. That means your salary from dividends could rise automatically every year without you lifting a finger. Think about that for a second. Your investment's giving you a raise while you sleep. That's the quiet, steady magic of dividend investing. Now maybe you're thinking, Mike, $400,000 still feels impossible. Fair enough. Let's explore other roads that lead to the same destination. Suppose you decide to go the balanced route, targeting a 1.5% dividend yield. That could be through an S&P 500 index fund, for example, where you get a mix of both dividend payers and growth companies. With this approach, you'd need roughly $800,000 invested to reach your $1 a month. Yes, it's double the capital, but you're also tapping into long-term market growth. Over time, your portfolio value itself increases, potentially faster than inflation and faster than many fixed-income strategies. Then there's the growth-focused route, which relies on lower-yield, high-growth companies. Maybe they only pay 0.5% in dividends, but their stock value compounds much faster. With that yield, you'd theoretically need around $2.5 million invested to hit your $1 a month target from dividends alone. Sounds crazy, right? But remember, these companies often deliver substantial price appreciation. So instead of relying purely on dividends, you could periodically sell small portions of your holdings to generate that same monthly income while your remaining investment keeps growing. It's a completely different mindset, one focused on total return, not just dividend checks. Now, before you start feeling overwhelmed by all these numbers, let's look at the bigger picture. The beauty of dividend investing is that there's no single right way. Each approach has its own balance of time, risk, and reward. Want stable, predictable income? Go for moderate yields around 3–4%. Prefer growth and flexibility? Lower yields can still get you there, but over a longer horizon. What you shouldn't do, though, is chase the extreme end of the spectrum. Those stocks or funds offering 10%, 12%, even 15% yields. Because when something looks too good to be true in finance, it usually is. Picture this. You find a company offering a 12% yield, and you think, wow, I only need a $100,000 to earn $1,000 a month. That's tempting, but here's the catch. A yield that high might signal a serious underlying problem. Maybe the company's stock price has crashed, maybe its earnings can't support those payouts, or maybe it's borrowing money just to maintain its dividend. That's not income, that's desperation disguised as opportunity. A sustainable yield is like a healthy heartbeat, steady, reliable, and built to last. When you see one spiking all over the place, that's a warning sign. Let's take a quick example. Imagine Company A offers a 3% yield. You invest $100,000 and earn $3,000 per year. Company B offers a flashy 12% yield. Same investment, but now $12,000 per year. Sounds great. Until Company B slashes its dividend by 78% when profits fall. Overnight, your income drops to $3,600 and your stock value collapses because everyone's selling. Suddenly, that easy money looks a lot like a very expensive lesson. That's why patience and judgment are your best tools in dividend investing. You're not just buying stocks, you're choosing business partners, companies you want to own for the long run. The smart play is to focus on quality. Look for companies with a proven record of stable profits, manageable debt, and a history of increasing dividends. That's how you build not just a portfolio, but a machine that keeps paying you month after month for years. But what if you want to reach that $1,000 a month goal faster, using a smaller amount of money? Are there any shortcuts that don't blow up in your face? Actually, yes. There are specialized strategies that some investors use, from energy stocks to REITs, that can accelerate your income. They come with their own risks, but if you understand them, they can be powerful tools in your plan. And that's exactly what we'll explore in the next part, the spicy side of dividend investing. High-yield sectors, real estate trusts, and individual dividend stocks that promise big rewards, and the hidden dangers behind them. Now let's turn up the heat a little. You already know the steady, safe paths, but what about the spicy side of dividend investing? The approaches that promise faster results with less capital, but can just as easily turn into a painful lesson if you're not careful. Let's start with one of the most common strategies, sector-specific investing. This is where you focus heavily on a single industry, hoping its higher yields will fast-track your income goals. Take energy companies, for example. Many oil and gas giants offer dividend yields around 4 to 5%, sometimes even higher. That means you could reach your goal of $1,000 a month with just $250,000 to $3,000 invested. Sounds great, right? Until you realize that the same companies can also swing wildly with oil prices, global demand, and even politics. When times are good, they're amazing. When oil prices crash, dividends can get slashed faster than your New Year's fitness goals. It's like riding a roller coaster that occasionally breaks down. Thrilling, but not something you want to rely on for a smooth retirement ride. That's why diversification matters. When you bet on a single sector, you're putting all your eggs in one basket and hoping that basket doesn't have any holes. Now, if you want something with a bit more balance, let's talk about REITs, real estate investment trusts. These are companies that own and operate income-producing real estate, office buildings, apartments, warehouses, even data centers. They're legally required to pay out most of their profits as dividends, which is why many REITs offer yields between 4% and 6%. That's right, so wait. With as little as $200,000 to $300,000 invested, you could be earning $1,000 a month. And the best part? You don't have to fix leaky toilets or deal with late-night tenant calls. You're a landlord without the landlord problems. But before you start high-fiving yourself, here's the fine print. REITs are sensitive to interest rate changes. When rates go up, borrowing costs rise, and suddenly those juicy dividends can start to look a little less appetizing. Their performance also depends on the health of the real estate market. When the economy slows down, REITs can wobble too. Still, for many investors, REITs are an excellent way to diversify and boost yield without taking on the risks of a single industry. Then there's the individual stock approach, which is where things get exciting and risky. This strategy involves handpicking specific dividend-paying stocks rather than relying on funds or ETFs. Some of these companies might offer 6%, 7%, even yields, meaning you could theoretically hit your $1,000 monthly target with as little as $150,000 to $200,000 invested. Tempting? Absolutely. Dangerous? Potentially. Because when you go down this path, you're essentially becoming your own fund manager. You're the one analyzing balance sheets, studying earnings reports, and keeping an eye on management decisions. And unless you have the discipline of Warren Buffett and the free time of a college student on summer break, it's easy to make mistakes. High-yield individual stocks can be like high-speed sports cars. They look incredible, but one wrong move and you're in the ditch. Sometimes a company paying a massive dividend isn't being generous. It's being desperate. Maybe its business model is cracking. Maybe it's losing market share, or maybe its debt is eating it alive. And when that happens, the dividend can vanish overnight. That's why many investors turn to what's known as dividend aristocrats, companies that have raised their dividends for 25 consecutive years or more. These are the rock stars of reliability. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. These companies have weathered recessions, wars, market crashes, and pandemics, and still kept increasing payouts to shareholders. Sure, their yields are smaller, often around 2.5% to 3%, but they're like financial gravity, predictable, steady, and always there. That's why so many long-term investors love them. To earn your one bond a month goal through dividend aristocrats, you'd still need around $400,000 invested. But here's the difference. Those payouts are built to last. They may start small, but they tend to grow year after year, quietly outpacing inflation and building your income stream without you having to constantly adjust your strategy. And that's the real secret of dividend investing. Sustainability beats excitement. A flashy yield might feel exciting today, but it's the consistent payers that make you wealthy tomorrow. Because at the end of the day, dividend investing is like any long-term relationship. You don't just want passion, you want reliability. You want companies that show up every month, year after year, doing exactly what they said they would. But here's the million-dollar question. How do you actually build that portfolio over time? What if you don't have hundreds of thousands to start with? In the next part, we'll uncover the strategy that makes all of this achievable, even if you're starting small. We'll talk about dollar cost averaging, reinvesting dividends, taxes, and how patience can quietly turn a few $1,000s into the financial freedom you've been dreaming of. So here's the good news. You don't need $4,000 or $1,000 sitting in your account tomorrow to start earning dividend income. The truth is, most successful investors didn't begin rich. They became rich by consistently investing small amounts month after month and letting time do the heavy lifting. This is where the concept of dollar cost averaging comes in. Instead of trying to save a huge lump sum, you simply invest a fixed amount every month, say $500 or $1, into dividend-paying assets. Over time, this strategy smooths out the market's ups and downs. Some months you buy when prices are high, other months when prices are low, but the average cost evens out, and your portfolio keeps growing steadily. And here's where it gets magical. As those dividends start rolling in, you reinvest them. That's the difference between staying where you are and building unstoppable momentum. Think of it like planting a tree. The first few years, it's small. Maybe it barely gives you any shade. But every season it grows, its roots deepen, and its branches spread wider. Soon, it starts bearing fruit. If you take those seeds and plant them again, that's reinvestment. Over time, one tree becomes an orchard. Let's put numbers to it. Suppose you start with $50,000 in a 3% yield dividend fund. In the first year, you'll earn about 1 tons in dividends. If you spend that money, it's gone. But if you reinvest it, you now own $51,000 worth of investments. Next year, your 3% yield is calculated on that larger amount, meaning you earn slightly more. That cycle keeps compounding every year. After 10 years of reinvesting, that $50,000 could grow to nearly $70,000, and your dividends could climb to over $2,000 per year. After 20 years, around $90,000 in value, generating nearly $2,700 per year, and that's without adding a single extra dollar of your own money. Now imagine combining that reinvestment with consistent monthly contributions. That's when the growth curve stops being linear and starts bending upward sharply. That's when compounding turns from a math concept into a life-changing force. Albert Einstein once called compound interest the 8th wonder of the world. And when you pair it with dividends, it becomes even more powerful. But there's one more thing you can't ignore. Taxes. Yeah, I know. Nobody wants to talk about them. But ignoring taxes is like driving cross-country and forgetting to budget for gas. It's not exciting, but it's necessary. In the U.S., if you hold dividend-paying stocks in a regular taxable account, your dividends count as income. Some are taxed at your normal income rate, while others, called qualified dividends, are taxed at the lower capital gains rate. That's good news, but it still means Uncle Sam gets a piece. Let's say you earn $1 in monthly dividends, 12 shillings per year. After taxes, you might actually pocket closer to $8,000 or $9,000 depending on your tax bracket. To truly net $1,000 a month, you might need to aim for closer to $1,300 gross monthly dividends. One way to minimize this is by using tax-advantaged accounts like IRAs or 401ks. Inside those, your dividends can grow tax-deferred or even tax-free in the case of a Roth IRA. The trade-off, of course, is that you usually can't withdraw that money penalty-free until retirement. So you'll need to balance flexibility with tax efficiency. Now let's talk mindset, because this is where most people lose. They get impatient. They start chasing quick results, high yields, secret stocks promising 15% returns. And when those bets crash, they give up. But building $1,000 a month in passive dividend income isn't about gambling. It's about discipline. It's not about predicting the next big winner. It's about staying the course through every market mood swing. Some months your account will drop. Some companies might cut dividends. That's normal. The key is to keep contributing, keep reinvesting, and keep perspective. Because here's the thing. When you own high-quality dividend-paying assets, you're not just earning money. You're owning pieces of real, profitable businesses. You're participating in the global economy, quietly earning income while the world keeps spinning. And one day, maybe sooner than you think, you'll wake up, check your phone, and see that same notification. $1 deposited. Only this time, it won't feel like a dream. It'll feel like the life you built. That's the power of starting early, staying consistent, and trusting the process. You don't need luck. You don't need a windfall. You just need time, patience, and a plan that compounds. So if you've ever wondered what financial freedom really looks like, it's not a mansion or a sports car. It's peace of mind. It's your money working for you while you sleep. I'm Mike from Mike Compound, reminding you that wealth isn't about how much you make. It's about how long your money keeps working after you stop. If you found this helpful, make sure to subscribe because your journey to passive income has only just begun.